Hi, welcome to this online session of Impact Taxation and Financial Services. In this session, we'll have a look at the concept of leading member discretionary trust. Okay, here is a brief introduction about myself. You can pause the video to have a quick look. And before we go to the main content of the presentation, I just want to make sure that if you need any professional advice, please find a good professional in their particular field to help you. So what we're presenting here, all the information provided are for general information only. Also, I want to give special thanks to Grant Abbott from Lightyear Docs and Abbott Morley Lawyers. So he's actually the director, one of the directors of Lightyear Docs, and also one of the partners of Abbott and Morley Lawyers. He's a great teacher and mentor. I have learned a lot from him through the CEPAPA course. So thanks to Grant for great strategies you have developed for asset protection and estate planning purposes. All right, so let's start. So why are we using a leading member trust? Okay, so a leading member trust will help you with below tax savings, asset protection, succession planning, and estate planning. So let's have a look at more details. Okay, so all right. So first of all, let's have a look at what is a discretionary trust. So a discretionary trust enables the trustee of the trust to distribute capital to a range of beneficiaries. Okay, so a beneficiary is a person receiving a capital payment or asset of the trust. All right, and also it can be used to distribute income to beneficiaries, including streaming specific types of income such as dividends, capital gains, interest, and foreign income. Okay, this is one area that's actually making discretionary trust or family trust very popular. Okay, so especially with capital gains tax as an example, you can actually pick and choose your family members to give them the capital gain. So if, say, for an example, you have a family member who might have carried forward capital loss from a prior year, so then you can actually pick that person to receive capital gains first, okay, then ahead of the other family members, okay, to help the whole family to reduce tax. All right. Okay, discretionary trust can also be used to conduct business and other operations, including investment for the benefit of the beneficiaries of the trust. So it actually happen quite often. People use a family trust. You can potentially run an online business, eBay business in a family trust, or a restaurant, or say a furniture store. So that they're all typical businesses. And then you can also use a family trust to invest to, on property market, on share market, okay, cryptocurrency, for example, okay. And then for all the profit you can generate from the investment of the business, you can distribute to the beneficiaries, okay, to average out the tax, okay. Okay, and so what are the benefits of discretionary trust? So as what I mentioned earlier, by streaming, so income streaming is, the capital gains distribution. First, you choose the family member who had capital loss before. That's a typical streaming. Okay, you can also pick and choose different people to receive a franking credit, for example, for the investment. So that's called income streaming. So by streaming income and specific types of income enables the trustee to spread the income around, and that will ensure the tax liability is spread across the family. So because of that, you can actually reduce overall family average tax rates. So why is that? Because for every one of us, every individual taxpayer, we have a tax-free threshold for $18,200. Okay, and on top of that, we also have a low income earner tax offset if our income is quite low as well. So that means low income earners, they pay minimum tax, and then high income earners are paying more tax. So by averaging the income, then the family can save, join together, save a lot of tax. Okay. All right. And then also a benefit of a discretionary trust is having assets in a trust structure will help to protect them from beneficiary and trustee creditors. So the reason being, when you think about it, with a family trust, there's no real owners of the underlying asset. A beneficiary doesn't own the asset. Okay, trustee is only the manager of the assets. Okay, a trustee is not an owner of the trust asset. So that means when they're exposed to third-party creditors, the creditors can't go through to get their asset in a family trust or discretionary trust. Okay, so that's the reason why it's actually a good asset protection vehicle. All right. So of course, before it's also used to help people to protect when they, if in case they're in a family breakdown situation, for family court settlement. So after some recent cases, the family court can actually go through family trust. So in a family breakdown, in a divorce situation, on some occasions, the family court can actually still go through the trust structure to get the couple to distribute in assets, okay, in the trust structure. So that can happen. Yeah, but even with that, it doesn't change the fact that trust is still a good structure to help a family to protect family assets. Okay. All right. So let's have a look at the key roles of a discretionary trust. Okay. Of course, there are other roles. We have listed the most important 3 roles here. All right. So the trustee is a person or legal entity responsible for administering the trust in accordance with the term of the trust deed. So here are a couple of things, very important. The most important document governing a family trust is trust deed. So this is really important. So that's why when someone is setting up a family trust, the trust deed is super important. Sometimes you might pay, say, $200, $300 to download a family trust online. Purchase from some like online companies. Are they really good for you? Are they covering all the, are they legally compliant? Are they covering all protections you need, okay, for your family to protect your assets? And maybe not necessarily if it's that cheap, okay? So you just need to be very careful. Yeah. Other things I want to mention here. So because the trustee can be a legal entity. Oh, let me go back to it. So it can be a legal entity. So that means a company, okay, that mainly means a company. A company can be a trustee, can be the trustee of a family trust. Okay, it's actually better to use a company as the trustee because it's a separate legal entity, it's actually adding another layer of protection, asset protection for the family trust. Yeah, because especially when there's no asset in the corporate trustee. So that's why when we set up a family trust with a corporate trustee, it shouldn't have an ABN number. Okay, this is a common mistake. Yeah, sometimes we have a new client and we notice, okay, the last accountant or maybe it was set up by even a solicitor. Then for some reason, the trust was registered with an ABN, or the trust or trust can have ABN, but the corporate trustee was registered. So the first step is with ASIC, with ACN. So ACN is necessary. Okay, you have to register ACN for the company or corporate trustee to be in existence. Yeah, but then you have to stop there. So a corporate trustee for a family trust shouldn't have an ABN, because ABN, only an operating business has an ABN. So that means you will have asset or profit kept in the corporate trustee. Then that's actually defeating the purpose of using it as a corporate trustee. All right, so there shouldn't be any active business or any asset kept in the corporate trustee. Okay, then of course the benefit of it is when you are changing the directors, you're basically changing the control of the manager of the trust asset. So it's actually making it easier to change hands of the manager, okay, instead of individual trustees. All right, there are other benefits of it. I think we made an online session before, yeah, so you can have a look at all the difference between different structures. Yeah, that might help you to understand. So also the okay, that's the first role, the trustee. Second role is the appointor or appointors. The appointor is the ultimate controller of the trust, as the appointor generally has the power to remove and appoint the trustee and determine the trustee's remuneration. Okay, so the appointor or the appointors, they are the most important people or person for a family trust structure. Okay, because they have the power to change, to appoint the trustee, right? Okay, the third role is the beneficiaries. The beneficiaries are the main persons or entities intended to benefit from the trust. Okay, so they're not only including individual person or natural persons, they also include entities. So that means you can actually have a company as a beneficiary, okay, or you can have another family trust as a beneficiary to a family trust. All right. So, but one thing very important, you can't use the corporate trustee as a beneficiary. All right, this is a common misconception. Sometimes we have new clients. They might ask the question, I have a corporate trustee. Can I use it as one of the beneficiaries? So remember, as beneficiaries, we call it like a bucket company. Yeah, bucket company means because it can receive money or distribution from the family trust at a better tax rate. You know, if it's passive income, it will be 30%. It's much lower than the high tax rate that's attached to a high income earner for an individual. Okay, so it's a great tax saving structure to have a bucket company or corporate beneficiary. Yeah, but remember, for a corporate trustee, there shouldn't be any asset kept in the company. Does that make sense? Yeah. So of course, the beneficiary company is to receive income or distribution. That's the main purpose of it. And then, if you are going to keep any asset into it or profit into it, then of course you can't use it as the corporate trustee. All right. So that's important to know. All right. then let's have a look. The next slide. So as what I mentioned earlier, who controls the trustee? The appointor has the power to appoint and remove the trustee. Okay, so in essence, they control the trust from behind the veil of the trustee. Okay, the trustee is at the front because trustee is the manager of the trust asset, but the appointor is the one sitting behind, but actually has the ultimate power. All right. Okay. So then, what are the key issues on a normal discretionary trust or trust deed at the moment? Okay. So, first issue is only the initial appointors are named. Okay. So when the appointor dies or loses mental capacity, the power shifts to the trustee, which may not be what is desired for family or financial reasons. Okay, so this is important. When there's no appointor, then the power will be shifted to the trustee. Okay, and then if the appointor goes bankrupt, it may limit their capacity to act financially and also potentially put the discretionary trust under attack. So that's not something we want to see. All right. And then also succession is the weakest link of many current discretionary trust and family trust in Australia. Okay. So this is the current main issue with most of the discretionary trust. Yeah. Okay. All right. And then what is going to be a better way? Okay, this is now we're leading to the concept we're introducing here, leading member family trust. So with the leading member discretionary trust, once the first leading member appointor is appointed, the leading member will control who can be the trustee, including the appointment and removal of the trustee. Okay? And then also has the capacity to veto many of the decisions of the trustee and can determine when the trust is to be wound up, and also through their veto power, which beneficiaries are to benefit from the trust and in what case. And also importantly, limit the beneficiaries to the lineage of the leading member or those persons or entities at the discretion of the leading member. So this is really important. Okay, so leading member will have the main power. So that will be the person behind the scene. Okay, the most powerful person behind the scene. And this person will make sure that all the family wealth that's kept in the family trust will be kept within the family and is not going out to anywhere to non-blood related family members, or basically to limit within the family that the leading member who want to distribute any benefit to, okay, only limit to the family members. All right. Okay, so the succession is the key of the leading member family trust. So it's quite similar to, with the royal family in UK. Okay, when they're passing down the monarchy. Okay, so it's actually decided many generations before. So even now, we already know who's going to be the next king or queen, and then the next one after it. So it's already pre-decided, a few generations before, right? Then likewise, the leading member family trust provides for a predetermined succession plan going down 1, 2, or more generations. Okay, so it is an important decision to be made upfront, as the family's wealth and control are in the hands of the leading member. So in this way, so it's very similar to UK. they want to make sure the monarchy stays within the family, okay? And then in a similar token, with the leading member succession planning, okay, or with the strategy, you can actually make sure the family wealth stays with the family. Okay, so this is the key. So how to set it up? Okay, so there are a couple ways to do it. So if you already have an existing family trust, okay, you can actually upgrade it to a leading membership, okay, leading member family trust, okay. But of course, there are hidden risks when you're doing this. So it could result in a closure of old trust and create a new trust. Of course, for this, we need to go back to the original trust deed to have a look, okay, whether this is allowed, and then whether potentially the beneficiaries might be changed. So it will depend on different factors. And then if it's get more complicated, we can also get the lawyers to help us from Evan Moyer lawyers, or like your docs. Okay, so when the old trust actually get dissolved, get closed, and the new trust, if it's accidentally created through this process, then potential capital gains tax and stamp duty issues will happen on the trust asset, because that will be treated almost like a transfer. So we need to be very careful before the change. Okay, we need to seek legal support if it's really complicated. All right, we need to have a look at your original trust deed as well. Okay, then the other way to do it is to create a brand new leading member trust. Okay, then of course, before this, you need to make some decisions. Okay, determine the leading member and successive leading members, and then determine who is going to be the trustee. Okay, then normally we always recommend a corporate trustee. All right, because it's just safer and easier for the succession planning. And then place any limitation on who can be a beneficiary, such as only lineage of any leading member or the former leading member. Okay, so this is really important as well. All right. Okay, so that's the end of the presentation. If you have any questions, so here is our contact details. Let us know, drop us an email, or give us a call. And thank you for attending this online session.